you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Clive Beagles, Fund Manager for J.O. Hambro Capital Management. Hello Clive.
Good morning.
Thank you for joining me here at the Morningstar Investment Conference. You've just done a great presentation on interest rates. I think investors hear a lot about interest rates, when they're going to rise, but what impact does that actually have on a portfolio? Because it's good news for those people who want to put deposits in a bank and bad news for people who have mortgages, but what does it mean for investors?
Yeah, well I think it's, we've been working in an environment where interest rates haven't gone up for 5 years, and as a result that's had quite a big impact on how different stocks and sectors have been valued in the equity market. So for us the key element actually is certain stocks and sectors will do well as interest rates rise, and actually some might do quite badly, and some of those may be sectors that people previously have thought about as being very defensive. Those actually may be some of the stocks that fare worst in an environment in which interest rates rise.
And one of the sectors that you highlighted that could do well if interest rates rise is banks. Now banks are a pretty controversial stock, especially in the last couple of weeks. We've had HSBC threatening to pull out of the UK market, with Clydesdale Banks back up threatening to pull out because there's so much risk around sort of PPI fines and all of that, but you're bullish on them.
Well, in many respects I think we've got to a breaking point, and actually I think HSBC's comments in a way may well bring about a major change. The problem for banks has been, the regulatory goalposts, if you like, have continued to shift to the right, and every time you invest, or the best description I think is that regulation has been written in pencil rather than pen. Whenever you think they just rub it out, change the rules and start again. And I think people like HSBC beginning to say, well look, this is getting so tight that if you don't do something about it, we're going to re-domicile to Hong Kong. Look, that's clearly a threat, and we'll see whether they react. But I think it reduces the risk of further regulatory drift in a more draconian way. Regulation in the UK and banks is probably the tightest of any nation in the world already. And so if that's the case, then actually the sort of valuation basis can begin to reflect companies who can begin to grow dividends and return capital. Lloyds obviously returns the dividend list and would like to distribute quite a high proportion of their earnings in dividend. If they do that, I think the stocks look quite attractive. So we've been quite slow to embrace banks because of this regulatory concern, but I think we are getting to a point where it struggles to get much worse.
And I suppose in a way, if everyone was singing and dancing about them, they wouldn't be attractive to you because you like contrarian bets.
We do, yeah, and it's exactly the sort of area. If you look at the areas that we currently find attractive, it's things like financials, it's areas like commodities, or it's small cap, all of which are less fashionable. That's what we do. We tend to dig around in parts of the market other people don't like, and tend to leave the more fashionable areas that right now would be biotech or technology or staples, all of which to us, lots of good companies in there, but they're valued on quite high multiples, and it's hard for us to see how you make money in those sort of names. You're more likely to make better returns from lower valuations as your starting point. And
you are rewarded with yield for that, but will you get some volatility in the share price along the way?
Well, you might do, but in some respects, because the environment we talked about, where interest rates are probably going to go up, probably will lead to a slightly volatile overall market environment. But in our opinion, that defensiveness best manifests itself in low valuations rather than what industry the company sits in. I think people lose sight of that. So, a small company on 6 or 7 or 8 times earnings, with a good balance sheet, may well be more defensive than a company in the consumer staples area on 23 times earnings with lots of debt. And yet, most people tend to think that those staples companies are more defensive than the other ones. I'm not saying I'm wildly cautious about markets, but I think we're probably due a period of volatility which might amount to sort of up and down, but netting towards zero overall for the market. But we can still find lots of individual names that we think still look interesting.
Stock selection is key.
Well, it always is. Yeah, that's the reality. That's what we do. We don't invest in economies. We invest in companies, and ultimately that's what drives performance.
Clive, thank you very much.
Thank you. Okay.
This is Emma Wall from Morningstar. Thank you for watching.